Then I finished it. And then senior year, I was like, I need to get my together and like actually. You were like,
As we wait for the last 30 seconds for the people to get in, a couple of reminders. One, of course, is that your final project is due on Monday. Doesn't have to be class, but the end of the day,
yeah, like honestly, they're all pretty cool. I did my very best. Yeah, I said I recommend teaching a day strategy of building a cabin style leisure resort via partnership with IKEA. Then I said subject to some revision to the operating subject. Yeah, so I said strengths, blah blah blah. Then I said
your final project is due Monday. The numbers that go into your final project, you need to put into your Google shared spreadsheet by midnight on Sunday. Okay. That's, there's a small inducement. You get 5 points out of your 40 points in the final project for getting the numbers in. It's 6 numbers, so it's a gimme. Don't leave it on the table. So get your numbers in by midnight on Sunday, because I need them for the next day's presentation. So today I'm going to kind of complete the cycle. This morning, and I started my corporate finance class, which I teach the MBAs. This is towards the end of that class as well. I closed the corporate finance class with a valuation section. So it's kind of the tail end of the class. This has been a valuation class, but I'm going to close this class with a little bit of corporate finance, but things come back into process. Because today we're going to talk about how to change the value of a company. Not just how to estimate the value, but how to change the value. So who might need the skill, changing the value? Give me the groups of people who cares about change in value. Yes. One is management. If you're CEO, top management, you care about change in value. Who else? You're a consultant, right? You're a McKinsey or a Bain or a BCG. I call you and say, what do I do to make myself a more valuable company? Change in value. You're an activist investor. Every time Carl Icahn opens his mouth, he's don't. I mean, you've seen this Musk Twitter thing play out, right? What's the story that Musk is telling? At least he's claiming that he can make changes at this company that make it a more valuable company. Whether you agree or not, that's his basic sales pitch. So today I want to talk about how do you change the value of a company. The way I describe it is, up till now, we've been the outside looking in. Now I'm going to bring you on the inside, and you can move the levers around and tell me what the ways of changing value are. Before I get started, though, I have to draw a contrast between changing value and changing price. This is a discussion we've had all through the semester, right? That what drives value and what drives price are very different things. Did any of you see the news story a couple of days ago about Alibaba? It actually turned out to be a fake news story. That the news story, I think it was tweeted out, that the Chinese government had arrested somebody named Ma. That was all it said. Somebody named Ma. And of course, people jumped to conclusions. Alibaba lost $26 billion in market cap in the next 15 minutes. Because somebody found out, that's not Jack Ma, why are we knocking off 26 billion? That's a pricing effect. Mr. Big falling off his Peloton bike in Sex and the City and your market cap, that's a pricing effect. In fact, to draw the contrast between value enhancement and price enhancement, because many CEOs claim they want to increase value, but what they want to do is push up the price. Let me give you the results of two studies that were done about 25 years ago. The first was done in the late 90s. And this study looked at about 60 plus companies that changed their names. The name of the study was called Rose by Any Other Name was the title of the study. They picked about 60 plus companies that changed their names. You're saying, what's the big deal? Companies change their names all the time. These companies change their names in a very specific way. They added .com to their names. Remember, there's a peak of the .com boom. And they hey, whoever's got the mic open, could you please mute yourself? But they changed nothing about their business. Let me ask you a question. If you're doing a discounted cash flow valuation of a company, remember that spreadsheet you had? And I said, what will happen if I add .com to your names and you do the same thing you used to do? What's your answer going to be? Absolutely nothing, right? Look at what happened to their stock price on average when they added .com to their names. We've been wasting our time for 27 sessions. We should have been on a naming convention, right? Which is what's the best name we can pick? Look, it's a 300%. Why are we focusing on cash flows, growth, and risk when changing your name can triple your price? In case you're tempted, though, let me draw your attention to a second study. This study was 4 years later. It also looked at companies that changed their names. You know what they did? They took .com out of their names. Because by 2002, it had become toxic. And this, I think, is at the core of why you should never try to go on a price enhancement binge. How do you enhance prices? By giving the market what it wants, right? So the market likes platforms, you talk about platforms. The market wants users, you give it more users. The problem, though, is the market is fickle. 2 years ago, if you were a COVID stock, a stock that benefited recovery, you were a Peloton, Zoom, Teladoc, they all Zoom. Today, if you mention that COVID is part of your story, it seems to make an effect which knocks your value down 50%. I don't know what enhances price. It's a mood momentum thing, and it's beyond me. But I can talk about what enhances value, and you all can, because we know that to enhance value, it's got to come from one of four things. The first is you can try to increase your cash flows from your existing assets. You can be more efficient, cut costs, increase profits, pay less in taxes, maybe have less working capital needs, very tangible things where you increase cash flows from existing assets. That's the first step. Second, you can try to get more value from the growth dimension. I didn't say don't go for more growth. In some companies, getting more value from growth will mean reinvesting more and growing faster. In other companies, increasing value from growth will actually mean reinvesting less and growing slower. By now, that shouldn't be a mystery. We talked about the value of growth, and we're going to talk about using them. Third, in the spreadsheet, when you become a mature firm, it's just a number, right? 10 years, 15 years, 20 years. But remember, value of growth comes from earning excess returns. The longer you can earn excess returns, the more valuable you become as a company. Mathematically, that's true. But then think about what I've just said in more qualitative terms. Where do excess returns come from? They come from competitive advantages, barriers to entry. The stronger your competitive advantages, the longer you can grow. If you can take your competitive advantages and make them stronger, you have a brand name, you make it even more powerful, it'll show up as a longer growth period and higher excess returns and a higher value. So you can increase cash flows, try to get more value from growth, build up your competitive advantage, and through that, the length of your growth period. And you can try to lower your cost of capital, right? Now, when I say lower your cost of capital, if you've taken a corporate finance class, you go to the standard place we all go. Change the mix of debt and equity. And it's true. Changing the mix of debt and equity can lower your cost of capital, but it's one of four things you can do. And I'll list out the other thing that could potentially also lower your cost of capital. Everything that happens in a restructuring will fall into one of these four buckets. So what I'd like to do is spend a little time on each bucket, talk about what kinds of companies this is the bucket you'd go to increase value. And then maybe I'll throw Twitter at you and say, if you were in charge of Twitter, Elon Musk likes you, hires you as CEO of Twitter, what would you change about Twitter to make it a more valuable company? So let's start with increasing cash flows from existing assets. I'm a mature company. I've fallen on hard times. My margins have shrunk. I'm very inefficiently run. You're hired as my new CEO. The minute you walk in, what are the two terms that you use a lot? Cost cutting and more efficient operations. Assuming you mean what you say. From a valuation perspective, what are you talking about? Increasing margins on existing revenues. You're not talking about increasing revenues, but increasing margins in existing revenues. You're saying, what do you mean by saying, assuming you mean what you say? A lot of people can talk the talk about cutting costs and being more efficient. Delivering it is more difficult, but that's where it shows up. So being more efficient will increase your margins. That will give you higher operating income, right? What's your next stop? You got to pay taxes. What I'm going to say next is going to sound unpatriotic, but take it for what it's worth. If you pay less taxes, you'll become a more valuable company, right? Now, I'm going to cover myself fully here. Within the framework of the law, if you can find a way to pay less taxes, you see how that's going to benefit you? Lower tax rate will increase your after-tax operating income. So for the same level of operating income, you have higher after-tax operating income, higher value. And then you turn your attention to what you're reinvesting to keep the company going, not even to grow. One, of course, is CapEx. And here I'll make a suggestion that should be common sense, but somehow companies seem to forget it. You've been investing over the last 8 years to 10 years. You built up a lot of excess capacity. There is no law that says you got to keep building a new factory every 3 years. If you have excess capacity, live off the fat for a while. What does that mean? For the next 3 years, the next 5 years, you stop making capital expenditures. Why? Because you have excess capacity. Your depreciation continues because that's from past CapEx. You get this cash flow that comes in for the next few years while you live off capacity. And finally, if you're a company with significant working capital needs, a retail company, lots of inventory, managing your inventory better can have a significant effect on your cash flows. Now, if you look at many retail stores that carry 7 colors of something, if you take the one color that sells worst and take it out of your mix, you'll be amazed at how much of an effect it can have on inventory and cash flows. That was the revolution that Walmart brought to retailing, because until Walmart came along, people took inventory as something that just happened to retailers. Walmart, right from the beginning, said, we're going to keep our inventory under control. And if you look at Walmart stores, they're very careful about what stays stocked up. If something is overstocked, you very quickly. So through their use of inventory control and putting pressure on suppliers, they managed to bring their working capital down. And in any individual year, that adds about $1 billion in cash flows to Walmart's bottom line. So that's your first stop. You're going to stop and try to extract more cash flows from existing assets. But let's say that. What kinds of companies is this going to be the place where you get the most value in terms of the life cycle? Is this the place you're going to go for Twitter? Can cutting costs make Twitter a more valuable company? If it is, it's going to be mild, right? I mean, this is the revenues of 5.6 billion. Even if you fired every Twitter employee, you're not going to make this into a $100 billion company. Now, I'm not saying there are not cost cuts to be made at Twitter, but I've seen stories floating around that the way Musk is going to make money in Twitter is by cutting costs. It's not, if that is his plan, it's a very bad plan. There isn't enough fat. It's not that kind of company. In contrast, if I pull you into a steel company, an old man, they might say, look, that's where I'm going to get my values, by cutting costs. Second stop, let's see if we can extract more value from growth. Let me revisit that old equation that drives growth. The growth in a company is a product of two numbers. How much do you reinvest? How well do you reinvest? Reinvestment rate times return on capital. Now I'm going to split my companies into two groups. First group is in good businesses. You know what my definition of a good business is, right? You're earning well above the cost of capital. The second group are companies in bad businesses, and you're going to see why I want to split the difference. If you're in a good business and you're not reinvesting enough, I'm going to put pressure on you to reinvest more. Why? Because you reinvest more, your growth will go up, but it's not just the growth. The growth is coming with returns on capital that exceed the cost of capital. So if you're a company in a good business, the value of growth can come from being more aggressive in your reinvestment, going into new markets, growing faster. But if you're in a bad business, guess what I'm going to push you to do? Reinvest less. In fact, push the reinvestment rate down to 0 and keep going. You're saying, how do I keep going? Shrink the company. There's no reason why you want to keep the company growing or even the same size if you're in a bad business. If you're hired as a CEO for a tobacco company, for God's sakes, don't map out plans to grow faster. Where are you going to grow and what are you going to grow in? Map out plans to shrink the company, reinvest less. Your value will actually be higher. If on the other hand, I hire you to be the CEO of a semiconductor company and you think this company run differently can have a higher value for growth, then of course you should be reinvesting more and trying to push up the growth rate. Yes?
When you say like don't reinvest more in like management, you say like a company that maybe is going to be affected by regulatory things?
Let's make it far simpler. Should Bed Bath & Beyond ever open another store? I don't think so. And in fact, the CEO of Bed Bath & Beyond talks about opening new stores. I'm going to slap him around the face and wake up. You already have too many stores. So it's not even regulatory overlay. It's a business has basically broken down. Then you shouldn't be. It's not all of retail, right? Costco opens a new store. I'm completely okay with it. Why? Because they earn above the cost of capital. They have a business model that seems to work. But if your basic business model is not working, then squeezing it and making it grow is not going to make it a better business. So there are a whole host of businesses. We can argue that this has happened because it's the other side of disruption. If a taxi cab medallion owner in New York City comes in and says, should I buy 3 more medallions? What's your answer going to be? What's wrong with you, right? Medallions dropped in value from $1 million to 150,000. This is a business that's only going to shrink. So any business that's been disrupted, that's become a bad business, you're essentially saying, how do I get smaller? Now that's your best path. The problem is your ego will get in the way, right? If you're the CEO, because he said, I'm going to rescue. Everybody wants to be an avenger, right? I'm going to rescue the company. I'm going to bring it back to life. And you don't want an avenger running a declining company. And I don't think you want Thanos running the company either, but I don't know who you want running the company. But maybe Thanos would not be a bad idea, right? He clicks his finger, the company turns to dust, and you move on. A lot of pain would be saved by doing that. The problem, though, the reason I make this big deal about growth being good or bad is unfortunately it's hardwired into us. I'll wager you leave this classroom, every other class you take, growth is a glorious thing, right? How do we grow faster? How do we grow more? And if you hire a consulting firm, God help you, they're not going to help you shrink. They're going to try to make you grow again. And they give you a menu of ways you can grow. And that's dangerous because one of those things should work for me. Now, I'm going to pick on one of those consulting firms that actually does some serious research based on its own proprietary data. It's McKinsey. If any of you get a chance, get on the McKinsey website, and you can actually register to read the McKinsey Quarterly. It's actually a magazine they publish, obviously, every 3 months. That's why it's called the Quarterly. But basically, it uses McKinsey's proprietary data to ask questions about, does this work? What works the best? So they actually do some really good work. And about a decade ago, they actually took their proprietary data, because McKinsey's been around a long time. They've helped a lot of companies with their growth strategies. They took their data and they broke down 5 different growth strategies in terms of how much value is created on average. So they're not saying it works for every company, but across the companies from best to worst. So let's start at the top. The very best way of growing across all growth strategies is if we can come up with a new product. The way to read this, $1 million invested in new product development creates about $1.75 to $2 million in additional value. So if I asked you for an example for a company that was able to grow with new products, you can take companies like Apple, right? 2000 through 2010, iPod, the iPhone, the iPad. It was like a decade of new product. But I have to add a caveat here. On average, it is true that new product development gives you the biggest payoff, but it's also a very skewed payoff. What I mean by that is the biggest winners don't make 1.75 to 2 million, they make 100 million, but there are lots of losers. In that decade where Apple kept trying new product after new product and succeeding, think of what Microsoft did. They tried new product, and every single one they tried failed. So it's not fail safe, but if I had to pick a growth strategy that's at the highest payoff, it's coming up with a new product. Second best growth strategy, expanding an existing market. I'll take an example, 30 or 40 years ago, if you're a bear and you produce aspirin, what do people take aspirin for? The only reason? Headaches, right? And then somehow, somewhere along the way, people discovered that taking aspirin thins your blood and that people who worry about heart attacks should be taking baby aspirins. There was a point in time about 10 years ago where 80% of aspirin sales to Bayer was coming from selling it to people who were taking it for heart health, not for headaches or other pains. So if you can find a way to get a new use for an existing product, it's the second best growth strategy. $1 million invested creates between 0.3 and 0.75 million in additional value. So any number greater than 0 is good, between 0.3 and 0.75. Let's keep going. Third best strategy is maintaining or growing your market share in a growing market. Now, normally when you maintain your market share, you feel like you've lost, right? But if the market itself is growing, maintaining your market share still delivers growth to you. Think of Samsung and Apple 10 years ago when smartphones were first coming into force. People still had flip phones, so you had this huge growth in the smartphone business. Apple actually lost market share between 2010 and 2015. But they actually got about 20% growth while they were losing market share because the overall market was growing. Those glory days are now gone because the market has kind of matured, it's stabilized. But it's nice to be in a market that's overall. This is the advantage that Indian companies and Chinese companies have over European companies. Is you have 1 billion people and many of them are just now starting to afford consumer products. You can get that buffer in growth that allows you to have a constant market share and still be able to grow year after year. And then you get to the two strategies that are iffy or bad in terms of creating value. One is competing for share in a stable market. Think about it. How do you get a higher market share in a mature market? What do you have to do?
Invest in a bunch of advertising.
Or cut prices or spend more on advertising, right? And the problem with spending more on advertising, if your competitor also spends more on advertising, you both end up losing and end up with lower margins. You cut prices and your competitor also cuts prices, you both end up with the same market share, but lower margins than before. If you're in a market that's mature, going for higher market share might give you growth, but it might not be value creating growth. And this shouldn't surprise you. What McKinsey found was the worst way to grow is what we spent the last session dumping on, acquisitions. Now, of course, I gave you that narrow path to success with acquisitions. Stay with private companies, stay disciplined. But clearly, across the companies that tried this, you can see very few were able to maintain that discipline. What does this all mean if you're going into a company and giving advice on growth? Higher growth is not always the answer, especially given the fact that so many companies around the world have a tough time making their cost of capital. This is a graph you've seen before. Basically, it lists out what percentage of companies globally earn less than their cost of capital, and 57% of companies globally don't make their cost of capital, earn well below the cost of capital. In other words, more companies should be shrinking than growing if they're looking at the basic facts they face as companies. So increase cash flows from existing assets, increase the value from growth by either growing faster or growing slower, depending on whether you're a good or bad business. Let's make a third stop. I almost never use strategic language in this class. I try to avoid it like the plague, but I'm going to make an exception for the next minute or two. To me, the only good thing that comes out of strategy class is they give you a lot of words for competitive advantages. Do this, do that. And it's good because it can become part of your valuation. Here's how it can become part of your valuation. As I said, the value of growth comes from earning more than your cost of capital, which is a fancy way of saying you have a competitive advantage, a barrier to entry that prevents other people from coming in and eating it away. So the first question I'm going to ask you as a company is, what's your competitive advantage? And if you can't think of any for the next 10 minutes, we're already in trouble, right? Because if you're a company that can't find a competitive advantage anymore, you've lost the script. Your business model is probably broken and you shouldn't be even thinking of growing. But let's say you come up with a competitive advantage. You say, I have a brand name. Then I'm going to say, are you using your brand name as fully as you could? Remember, brand name can have value. For Coca-Cola, 80% of its value came from brand name. But brand name is not permanent. You can have good brand names that dissipate over time. Quaker Oats at one point in time was legendary brand name for oatmeal. And then it kind of lost the brand name over 30 years. It's now tried to rediscover it. But brand name value is not there forever if you don't take care of it. So you can mangle a brand name if you're not careful. So one of the things we're looking at here is, if you have a competitive advantage, can I make it stronger? And if you don't have one, can I find one? So the risk of missing things, I'm going to start 4 possible competitive advantages. The first, of course, is brand name. How do you get it? God only knows. You think it's marketing? We really don't know, right? It's a combination of marketing and mystery, and the fact that you saw somebody holding a can of Coke in their hand in 1957 in a movie. And I mean, it's, if you could recreate what creates brand names, we'd spend money and get a brand name. But if you do have it, you want to nurture it and perhaps make it stronger. And don't risk it by attaching your brand name to something that could actually bring your brand name down. That something could be a celebrity. And let's face it, you could attach your name to a celebrity. I mean, remember how much money Nike had to spend to extract themselves from the Tiger Woods fiasco, right? It could be that you put your brand name on another product. Often that's attractive, right? Licensing fee. But what if that product turns out to be something that rubs off in a really negative way on your brand? Second step. If you can get legal protection against competition, should you look for it? Of course, right? In fact, that's what we do when we get a patent. We're trying to get protected against competition. You're saying, shouldn't every company already have? You'd be amazed at what companies have let slip through their hands, because at the time they developed the product, they did not think that anybody would want it. I'll give you an example. I mean, I don't know what laptop or computer you use, but we all use an interface. We use a mouse to move and essentially all of us have gotten used to clicking and using a mouse to move things around on a desktop. That wasn't always the case, right? In the early days of PCs, it was geeks who ran the show. They thought that you liked writing things like del / x. No, basically they thought that who'd want to point and click? You know who created the Windows, that interface that we're also used to now?
Xerox.
It was not Apple, it was not Microsoft. Xerox in a lab called the Park Lab. It's actually it was in Silicon Valley. It was a lab, they developed it, but they said, who wants something like this? This looks so easy. People want to enter the geek land that we're in. They didn't ever get legal protection for what they developed. It's, Steve Jobs and Steve Wozniak, visited that lab early on, and that became the basis for the original Apple operating system, which Microsoft copied 10 years later with Windows, but now everybody kind of uses. So if you can get legal protection, get it, but with one caveat. Sometimes governments will give you legal protection, but in return for giving you legal protection, they will take away something even more critical. I'll give you the example of phone companies and utility companies still today. They're called regulated monopolies. You know what they were called, regulated monopolies? You were the only company allowed to deliver phone service. And you're a publicly traded company. This is great, right? No competition. But in return for having the monopoly, what were you required to give up?
You have a fixed price that you have.
In other words, the nice thing about being a monopoly is everybody hates you. That's not the nice thing. But the way you get back with them is you charge them 3 times more. It makes you feel a lot better. You hate me, 3 times more for you. Unfortunately, if you're a phone company, you're a monopoly, everybody hates you, you get ready to charge them 3 times more. It turns out there's a regulatory commission that the government has that you got to go through that says 3% this year. In other words, if you're going to get legal protection, don't let it be at the expense of pricing power. Third stop, switching costs. This actually sounds mysterious, but here's how it works out. If you're a company, you want to make the cost of switching into your product as low as possible. But once people switch in, you want to make the cost of switching out as high as possible, right? Every time you walk past a cell phone store, remember this, right? There's this big poster in the front. If you're an AT&T store, if you're a Verizon user, come on in 2 minutes, we'll switch you to AT&T. And they will. Cost to switch. And then once you switch in, they make you sign this 24-page contract in tiny font that nobody reads. And in the process, you've basically locked yourself in for the next 3 years. If you want to get out, you can, but you'll have to pay us $2,000. Switching costs. Basically, it's become in technology the big factor. I also call it stickiness, people sticking in your model. Yes.
But also, like, has it just become an overall, like, it didn't really work that way, because then the other companies now like saw that and they're like, okay, we'll pay for your contract to end. So now they're all just like paying for you.
In other words, they all become less profitable at the end, right? In a sense, you can go after this model, but eventually everybody ends up less profitable. Which brings me to my fourth potential competitive advantage. If you have some kind of cost advantage over your competition, there are two ways you can exploit it, right? One is you can charge the same price as everybody else and make a higher margin, or you can charge a lower price and take over the market. Take Aramco. What's Aramco's biggest competitive advantage? It's no brainer. They have oil under the ground that they can get out for $6 a barrel. So $20 a barrel, they're the only oil company in the world that can still make money. If they wanted to, they could push the price down to 20, produce 100% of the oil. The problem is there's only 330 million barrels of oil under the ground. And it's in their best interest not to go for 100% market share. I think Aramco is far happier with oil prices at $100 a barrel, because then you make $94 in margins and you become a much more profitable company. Which raises an interesting question. How do you get these cost advantages with Aramco? How did they get the cost advantage? They were endowed with it, right? They're the Saudi oil. So the government basically said, you are the oil company, you get oil. It's not like the management at Aramco went and earned this right. It wasn't that they explored for the oil and discovered it. So let's not be giving bonuses to these managers for that competitive advantage. It was endowed. Yes.
But why is like the oil so much cheaper? Is it like just like
It's just the oil is, yeah, it's just pure
It's
geography.
easy
Which
to like get the oil inside of
you stick your finger in the ground, oil comes out. I'm
So it's like
serious.
instead of like
Yeah.
fracking it out.
So if you run out of gas in the sands, just stick your finger. You'll have to figure out how to get the gas into your car. But if you can, but it's just the geography. By its very nature, the Middle East, oil is not just plentiful; it's very easy to extract. So when people talk about oil in the U.S., remember it's shale oil. It's a lot more work to get to, and a lot more costly to extract. So even if you have the same number of barrels of oil, it'll cost you more and you'll be a less valuable company. But you can also earn cost advantages, right? You can go out. Now you're not endowed with it, you do something to get it. When Dell first came out as a company, it had a cost advantage over Compaq because it ran its factories much more efficiently. It cost less to make a PC. So early on, Dell wiped out Compaq by having the cost advantage, which they exploited by charging less for a PC or giving you more stuff for the same price. But to show you how things can shift, 10 years later, Lenovo had a cost advantage over Dell because they made their PCs in Asia and Dell was paying more. So cost advantages too can shift over time. And what started as your competitive advantage might become a disadvantage. So here's the bottom line. You walk into a company, first thing is you got to figure out what the competitive advantage is. If there's none, you have your job cut out for you. You got to figure out how you create a competitive advantage for your company. Once you have a competitive advantage, you got to preserve it and augment it because it shows up as longer growth and a higher excess return. Which brings me to my last way of increasing value. Maybe you can lower your cost of capital. As I said, after corporate finance class, the way you think about lowering cost of capital is let's use more debt, let's get a lower. And that's true, that's one place you can go. But be careful, it's not as simple as it sounds. Increasing debt doesn't always lower your cost of capital, and we'll talk about why. But there are three other things you can try that can also lower your cost of capital. If you have mismatched debt, you know what I mean by mismatched debt? You're using euro debt to fund Turkish lira assets, short-term debt to fund long-term assets. You're creating default risk that you don't have to. Shows up as a higher cost of debt and a higher cost of capital. If you can somehow make your debt a better match to your assets, you've lowered your default risk and lowered your cost of debt. And today you have tools to do that, right? You can use swaps, you can use derivatives, and by doing that, you can essentially remove the mismatch. But the other two ways to lower your cost of capital go back to what we talked about when we talked about betas. Remember I said if you have discretionary products or services, you will tend to have a higher beta. What if you could make your product or service less discretionary? How do you do that? How many of you could live without your cell phones for a day? Forget about a week or a month. Remember when my kids were growing up, it was the only threat that worked. Will take your cell phone away. In a sense, it's become almost, without a cell phone, you probably don't know where you live, right? You don't know your name, your contacts are all there. You know, where are my parents? I don't know who are my parents. Let me look it up. Let's face it. Cell phones 20 years ago might have been a discretionary product. They've increasingly become non-discretionary. If you can find ways to make a product or service less discretionary, you in effect lowered your beta, lowered your cost of capital. Well, in a sense, at the extreme, in its extreme form, it takes the form of an addiction, but it doesn't have to get that far in. You just have to make it a necessity. Which brings me to the fourth and final way you can lower your cost of capital. Remember I said the higher your operating leverage, the more fixed cost you have as a company, the higher your beta. If you can find a way to make your cost structure more flexible, you've in effect lowered your beta, lowered your cost of capital. You know, how do you do that? Well, think about what outsourcing does to risk. What have you done? Let's say you had 10 copiers. NYU, for instance, had, Stern had like 10 copiers down in the basement. We had to run the, now it doesn't. It's managed to outsource copying. So now I have to do copying. I have to send this request somewhere. They send it out somewhere else. What's the advantage? If there's not much copying to be done, your costs are low. So in a sense, they've taken a fixed cost and replaced it with a variable cost. The other thing that, especially in the last 20 years, you've seen in the US, at one point in time, when companies negotiated with unions, it was all about getting a lower wage agreement in place with the unions. Now, actually, what companies want is a flexible. Now, what that means is we're willing to pay you more, but we want to tie how much we pay you to how well we're doing as a company. What that effectively is doing is lowering your fixed costs and lowering your beta. So here's what I'd like you to do. I'm going to show you two companies. I'm going to let you play the role of CEO of these companies, and you're going to fix them based on where you think value can be added here. So let's start with the first company. It's a German company called SAP. It's a software company that competes with Oracle. It's a business software company. And this is a valuation in 2005. I won't give you the details of the valuation, but I'll give you the high points. This is a very profitable company. It generates 1.4 billion euros in after-tax operating income. It's reinvesting a fair amount, about 57% of its after-tax operating income. And it earns a really good return on capital. You know why? As I go through, you're checking for things. If I said they're earning a low return on capital, if low margins, you're going to put a check saying, maybe I should come check on that. Maybe I can figure out a way to increase. It looks at least that this company is pretty well run, has decent margins, has a great return on capital, and it's reinvesting a fair amount. The one negative in that reinvestment is they've tended to reinvest primarily in the US and Europe. And they've not reinvested much in Asia because the management is not that comfortable with risks in Asia. Now, how have they funded the company? It's 99% equity, 1% debt. Now, I understand it's a tech company, it shouldn't borrow much money. But this is a money-making company with lots of cash flows, saying, why don't they borrow more? Again, the management is conservative. They don't like to borrow money. But they're running the company right now. I'm going to value the company in their hands. It's called a status quo valuation. You're valuing the company, the existing management running the company. The value that I got was 106 euros per share. File that away. You're now the new CEO. You come in, and I think of at least two things you can do. One is you can ask, maybe I can use a little bit more debt, right? Before you decide how much more debt, what do you have to check? You have to check whether 10% or 20%, you can't just say use more debt, right? You have to figure out what the right mix is. And that's what I started with. I looked at what the cost of capital would be at different debt ratios from 0 to 90%. So it's very mechanical. At each debt ratio, I compute a new levered beta, a new cost of equity, a new cost of debt. But the key is their cost of capital is minimized at about 30% debt. So they're right now at 1% debt. They can go to 30% debt. What will they benefit from doing so? They'll have a much lower cost of capital. Instead of an 8.24% cost of capital, they'll have a 7.47% cost of capital. Now, as a new CEO, you might not have the aversion to investing in Asia that these existing managers do. So I assumed that they could reinvest a little. I didn't go crazy. I didn't say go out and invest 200%. I said invest a little bit in Asia. Go for the markets you're most comfortable with. But with those two changes put in, a higher reinvestment rate and the fact that they have a mix of debt and equity that is now optimal, the value that I get per share is about 126 euros. If you remember before, it was 106 euros. Now it's 126.5 euros. By making these changes, I've increased the value per share by 20.5 euros. What should we call that difference? I mean, this is a word we've kind of used in the context of premiums and loose ends. We've talked about the value of control all the way through the class, right? This is the value of control. Because you run the firm and you're saying, what do I change? And you see the effect play out in that. Now, unfortunately, in this case, that 20.5 euros is roughly 20% of the value, right? So if a bank over here, he'd say, well, you know, this is backing for using that 20% premium. But to show you why the 20% doesn't always work, let me try a second company. This is from 2003 or 4. It's valuing a company called Blockbuster. It's gone now. I think there's one Blockbuster left as like a legacy store, the very first one that people go to visit. No, it's like a shrine. But there was a time when Blockbuster was a fast-growing, dynamic company. It was actually created as a roll-up. You know what a roll-up is? You go around buying small video stores around the country and you roll them up into a big company and you went public. In the 1990s, they were growing at 15, 20% a year. You blinked and another Blockbuster around the corner. And then tragedy hit Blockbuster. In 1999, a company called Netflix was created. That squeezed them on one side because Netflix said, you want the greatest hit that's in the movies, we'll mail it to you. You don't have to go to that stupid Blockbuster store and sign up and wait for 2 weeks. We'll mail it to you. And on the other end, Walmart and the other stores opened these red box video, where you could actually go rent a video for $1. So they were squeezed from both sides and people stopped coming into Blockbuster stores. They didn't seem to notice the company. They kept opening more stores. This is what happens when inertia drives the process. They're reinvesting more money, that's the reinvestment rate, more stores, and they're earning a 4% return on capital as they're investing in these stores. Their cost of capital is 6.17%. So are they growing? Yes. Should they be growing? I don't think so. So let's say you walk into Blockbuster. What's the first thing? What's your first action as a CEO? You don't have to do anything aggressive. Stop opening stores, right? Guys, this is not working. Stop opening stores. Nobody's coming in. If you did that, all you did was stopped opening stores. You earned in other words, you go back to zero net present value. I'm not asking for miracles. The value per share goes to 12.47. 5.13 to 12.47, that's 150% increase in value from just doing nothing. You know what people often say, just do something? It drives me crazy when people say, no, don't just do something, because doing something can often create more damage than doing nothing. Just do nothing until you figure out what to do, then do something, right? If you just do something, you get Blockbuster. Later on, I'm going to come back and talk about what this did for Blockbuster, because Carl Icahn in 2004 took a position in Blockbuster. He had a very simple plan for them. What is the plan? Stop opening stores and give me your cash. That's pretty much the two-part corporate finance restructuring. And for a company like this, you can see why it works. Now, before we leave these examples, I don't know whether any of you saw my Twitter status quo valuation. With Parag Agrawal and the existing board, I tried to value the company. I'm saying, look, they're making incremental changes. They moved in the right direction, perhaps not at the pace. And the value that I think I got per share was about $45 per share for their existing business. I don't want the answer to this, but I want you to think about if you were brought into Twitter as the CEO, where in these 4 dimensions we talked about do you see the greatest potential for increasing value? We already said it's not going to come from cutting costs. Is it going to come from tweaking capital structure? I don't think so. It's not like Twitter is a massively under-levered company, right? It's not like they can borrow 60%. In fact, they'd be lucky to get to 10% debt ratio. So it's not capital structure, which leaves us with two questions. What is their competitive advantage? Is there something they can do to augment it? And how can we translate that into a higher value for growth? This is really the challenge, right? The competitive advantage, of course, comes from the fact that they have a platform that 330 million people visit on a regular basis, 250 are regular daily average users. And what's the best way to get value of growth up? And this is where the subscription versus the advertising models are going to come in. I don't think the answer is easy. This is not going to be an easy fix. I'm curious to see what Musk is planning, especially given that today he said that he plans to take the company private. Did you read what he plans to do later? He plans to take it back public again, which means he thinks that he can make changes to the company that could potentially make it an $80 billion company. No? But it'll be interesting to watch what the change in the model is that you're doing. But you can see why one size doesn't fit all. Okay? My problem with restructuring in general is people read out of cookbooks. They take whatever worked in the last company, they apply it in the next company. And it's not going to work, right? Because each company requires a restructuring solution that's basically structured around that. So here's what I'd like to do. I'd like to take about this value of control that we've talked about by valuing the company twice. And in fact, each of you, if you wanted to, this is not part of your project, could value a company again. Not, you know enough about your company that you can make at least first level judgments on, hey, what would I do differently at this company? You're valuing Peloton, quite a few of you are. You could say, maybe it's worth more as a subscription business than it is as a fitness equipment company. Hey, you can revalue the company as a subscription business, and it could be worth more. There's not much you can do about it because you can't take over Peloton. You don't have the money right now. But that's the first step. Do the status quo value and what we will call loosely the optimal value. Value the company with changes. But to make those changes, guess what you have to do? You got to change the management of the company. And that's not always easy, right? In some companies, it's going to be impossible. Let's say you look at Facebook and you say, you know what, Facebook is badly run. It can be run much better. It can be run differently. There should be a retail company. What's the problem you're going to face in changing management? The fact that Mark Zuckerberg owns 57% of the voting shares, right? How the heck are you going to get around that? If you're in a country where no hostile acquisitions, remember, anytime you're talking about the value of control, almost by definition, if you're trying to take over the company, it has to be a hostile acquisition. Do you see why? Because what's your starting point? There's a status quo value and it's low. Why? Because the existing management is not competent. How do you get from there to a friendly merger? How do you tell somebody you're incompetent? Oh, by the way, let's make a friendly merger. So almost by definition, you need hostile acquisitions. But the problem is there are still countries in the world where hostile acquisitions are not allowed. You can't do a hostile acquisition. It's not allowed based on the market structure. I don't know when the last time there was a hostile acquisition in China. Have you wondered why there are no hostile acquisitions in China? There should be, right, in every market, but there are some markets where hostile acquisitions just can't happen. In some cases, the limits are implicit. You can't raise capital to do an acquisition because banks will not lend money to you. In Europe, until European companies were able to issue bonds, hostile acquisitions didn't happen because when you tried to borrow money, banks would say no. I know somebody tried to do a hostile acquisition of Fiat in the late 80s, the early 90s. And he went to an Italian bank and he said, I'd like to borrow money to do a hostile acquisition of Fiat. What an Italian bank. So I'd like to take over one of your biggest institutions. And everybody in Italy knows everybody else, right? There was no way you were going to be able to raise capital. So you're going to look at things like takeover restrictions with Facebook's voting rights and rules, how much access you have to capital, and how big the company is. Let's be realistic. If you think Apple is badly managed and badly run, just let it go. What are you going to do? Go raise $3 trillion and try to take over the company? Right? So all those things will come into play in terms of, can I change the company? So when you look at this probability of control changing or management changing, you are going to look at corporate governance rules, because that's really what corporate governance is all about, is how quickly can change come. And those rules are changing all the time. 20 years ago in Brazil, doing a hostile acquisition was almost impossible. Corporate governance rules, even in Brazil, have changed to the point that you can do hostile acquisitions now. Second, it's good to have the Carl Icahns and the Bill Ackmans in your market. Much as I tell people, look, I don't like Carl Icahn. I don't want to go to dinner with him. I'm afraid he'd eat me. But I'm glad he's around, because when he puts pressure on, I can't put pressure on a company to change. We need, I describe and this is, some of you might find this distasteful. I describe activist investors as, what's the nicest way to say this, as the laxatives that markets support. You know why I go? Because if you don't have laxatives, you're going to get constipated markets. European markets, notoriously constipated. They just get stuck and there's no place to go. Think of activists as basically, they're irritants. They're not meant to make you feel good. They're meant to keep things moving. Next time you complain about Carl Icahn doing something you don't like, ask yourself whether you want to market. There are no Carl Icahns and Bill Ackmans doing that, because you're going to get a lot of badly run companies when nothing changes. And finally, it's amazing how much signaling there is when you see a hostile acquisition. Even if you don't like what Musk is doing at Twitter, trust me, every technology company is now looking at what it's doing, saying, should we be worrying about the fact that somebody might take us over? And to me, that's a healthy thing to happen. When managers say, are we doing the right thing? Because this is something everybody should be asking every day with whatever they do. But having a hostile acquisition can change the probability of change. It's, if you ask me, can I put a number on a probability? Is it 20% or 30%? There's a way to do it, but you might not like the work involved. You've all run multiple regressions, right, for your pricing. You have a dependent variable and independent variables. There's something called a probit that looks very much like a regression, but in the probit, here's what you try to do. Let's say you wanted to estimate the likelihood that companies will become targets of hostile acquisitions. And you asked me to do the data analysis. I'm going to go collect data for the last 10 years on every company that was acquired in a hostile acquisition and every company that wasn't. So let's say over the last 10 years, out of 10,000 companies, 500 were acquired and 9,500 were not. I'm going to put a 1 against the companies that were acquired and a 0. So basically, if you think about an Excel spreadsheet, for the 500 companies that were acquired, I'm going to put in a 1. And for the 9,500 companies that were not acquired, I'm going to put a 0. And then I'm going to think about what is it that might make a hostile acquisition more likely. We know that companies whose stock prices have done badly are more likely to be acquired than companies whose stock prices have done well. So I might look at stock price performance over the last 5 years. We know that companies with smaller and more effective boards are more likely to be acquired than companies with big and ineffective boards. So I make a list of variables, I collect that data. And then I run a regression with this 0, 1 variable as my dependent variable, and all of those things that I think affect it as my independent variables. I'll end up with something that looks like a regression equation. But if you plug the numbers into that equation for your company, how big the board is, how well its stock is done, what you get as a predicted value will be a probability that your company will potentially be the target of a hostile acquisition. It sounds like a lot of work. 20 years ago, I'd have said, don't even try it. It's not worth the work. Today, we have the data. It shouldn't take that much work to do this on pretty much any event that you're worried about. What's the chance of it happening? So let me talk about the places where knowing what this expected value of control can help you. The first, of course, is in hostile acquisitions. When you're doing a hostile acquisition, you're doing it for control, for change. I think you need to know what that optimal value is, because it'll tell you when to stop, right? You can't push your pricing above that. Remember, you pay the wrong price. It doesn't matter that you got a lot of control value, you've overpaid. Second, I'm going to argue that in every publicly traded stock, what you see as a market price already reflects an expected value of control. What I mean by that, if markets think that you might be taken over and changed, they don't wait for the takeover to happen. They start to push up the price right away. And I'll give you a way in which you can extract that probability from the market price. Third, there are companies with voting and non-voting shares. Latin America, this used to be par for the course. In the US, we tended not to have these companies until Google came along. Now, every tech company pretty much that's gone public since 2004, with the exception of Twitter, has voting shares, high voting right shares and low voting right shares. Now we know intuitively that voting right shares should trade at a higher premium than non-voting shares, right? It's amazing how little people know about how much that difference should be 3%, 5%. So I'm going to give you a way of estimating how much of a premium voting shares should trade at relative to non-voting shares. And finally, in the context of private company valuation, there's something called the minority discount. Let me explain what that is. You have a private company. You bid 51% of the company, you bid a number. You bid 49% for that same company. You pay a much lower number. You're saying that's only a 2% difference. Why would I pay a much lower number? Because when you buy 51% of a private company, you run the company. You can make changes. You buy 49%, somebody else runs the company, and you're stuck with what they do. We'll talk about how to quantify that discount. So let's start with hostile acquisitions. In the context of Blockbuster, of course, the value that I got with the status quo was $5.13. The value that I got with changes put in was $12.47 per share. The actual stock price was $9.50. You decide to do a hostile acquisition of Blockbuster. What's the maximum premium you can pay over the market price? Price is $9.50. The optimal value is $12.47. You can pay up to $2.97. And if you pay exactly $2.97 as a premium, guess what you've done? You've essentially given the entire control premium to the target company shareholders, and now you have the job of actually extracting that premium and making changes. So already you can see that if you know what that optimal value is, you're going to try to get to pay less than that optimal value, maybe $11, maybe $10.50, because you want to keep the difference. So when Elon Musk is paying $54.20, if he's actually worked out in his head what roughly the value of Twitter is, I hope it's more than $54.20, right? That's 60 or 70, because if he's going to make all these changes to it as a private company, then he should be getting some of that increase in value. As I said, the market price already reflects what the market thinks about the likelihood of change. And to show you how you can back it up, remember the two values I got, 513 and 1247? And I told you the stock price was 950. If the stock price is 950 and you accept my two valuations, I can actually back out the probability that control will change based on the market price. It's just algebra, right? One equation, one unknown. And at a $9.50 stock price, the probability of change the market was incorporating was about 59.5%. You think, so what? This was after Kyle Icahn had shown up and made this play for the stock. Before he showed up, the stock was trading at like $8. The probability of change was like 40%. Now do you see why when an Icahn or an Ackman takes a position in your stock, you're going to see a jump in the price? It's got, not that the value's gone up, but the likelihood of change has gone up, and the likelihood of change goes up, you're going to see the market price reflected. So hostile acquisitions, market price for every publicly traded company. Let's talk about voting and non-voting shares. Let's play again. I'm going to be a company, I'm going to issue voting shares to this side and non-voting shares to the rest of you. I raise capital, I start the company. As non-voting shareholders, what have you given up? You've given up any say in how the company's run. You're getting a share of the cash flows, but that's it. In a sense, you're stuck with the status quo, right? You can't do much about it. The voting shareholders at least have a chance to create change if they wanted to. That's the insight I'm going to use to extract the premium for voting shares. So if you're a non-voting shareholder, I'm going to take the status quo value. And I'm going to say that's all you're stuck with. There's nothing you can do because you're a non-voting shareholder. I'm going to come up with the value per share. Then I'm going to take the expected value of control, and I'm going to divide it just by the voting shareholders, saying, you guys control whether we can change management, and you get that extra premium. Yeah.
Wait, doesn't this kind of, like, because you talk a lot about how, like, the control premium is ridiculous, but, like, doesn't this kind of go against, like, now you're saying there is a value to the, I mean,
there is a value. There is a real value to control.
It's just not 20% that, like,
Exactly, right? If it's perfectly managed and perfectly run, what's the value of control going to be?
No, zero, because
Sure.
it's already run.
So when I talk about, so when I say you should pay a premium for synergy, I'm not saying there's no value for synergy, but don't make it 15%, because synergy can be worth $1 billion. It can be worth nothing.
Exactly worth what's actually.
Exactly. So we're going to talk control. Let's talk control. which means you got to talk specifics. What are you going to change in the company? Let's value that. So if the argument is that Musk is paying a control premium for Twitter, that's kind of neither here nor there. I want to know what he's going to change and whether in fact what he's changing will create the extra $9 or $10 or $11 per share. So let's try this. No, I don't know whether you're familiar with a company called Embraer. Embraer is a Brazilian aerospace company. We've talked about it in earlier classes in terms of coming up with the cost of capital. About 15 years ago, I valued Embraer and I did two valuations. It's actually very easy near DCF. You actually do a second in 15 minutes, make some changes, you come up with two. In this case, I have a $12.5 billion status quo value and a $14.7 billion value if they can make some changes. So I'm going to, and with Embraer, they have two classes of shares. They have 242.5 million voting shares and 476.7 million non-voting shares. So what I'm going to try to do is first value the non-voting shares. To value the non-voting shares, I take the 12.5 billion, that is the status quo value, and divide it by the total number of shares outstanding, saying, look, you bought the non-voting shares, you get a share of the status quo. That gives me $17.38 per share. And then I turn to the voting shareholders. The voting shareholders, if you think about the difference of 2.2 billion, that's a value of control. But to get that value of control, you need to change the management of the company. In the case of Embraer, that's going to be difficult to do. And here's why. Embraer used to be a Brazilian government-owned company at one point in time. It's no longer government-owned, but there's a heavy government influence in how the company is run. This is not going to be an easy company to change. So it has only a 20% chance that change can happen. It's not as bad as Vale or Petrobras in terms of control, but the likelihood of change is low, 20%. You take 20% of 2.2 billion, divide by just the voting shares, you get a value per share of $19.19. Voting shares here will trade at a premium of roughly 1.81 reais per share, right? No, a little over 10%. But think of what? If I made the likelihood of change zero, the government says, no, you can't change the company. What's going to happen to the value of voting shares? They're going to converge on the value of non-voting shares. If the government says, all hands off, you can come in and change it, you could very quickly see a jump in the voting shares and the non-voting shares will kind of stay stuck while the voting shares leave. We talked about Facebook. Facebook has high voting shares and low voting shares, Class A and Class B shares. They trade at roughly the same price and that puzzles people. But do you see how you can explain it? Why do Facebook's, you can either say it's a perfectly run company. That might have worked 3 years ago, clearly is not going to work now. But what's the other explanation?
Those voting shares don't have any real power.
In this case, the voting shares, 57.5% or 57% of the voting shares belong to one man, Mark Zuckerberg. So the fact that you own the voting shares tells you, no, there's nothing you're gaining in this. The probability of change is zero or close to zero. You can already see why voting and non-voting share premiums can vary across companies and vary across time. Which brings me to this minority discount. And it's a very simple, I'll give you a very simple example to illustrate. Let's say you've taken a private company, the Christian Candy, remember that we valued, the privately owned candy company? No, we didn't value it. Okay, let's say I valued it twice. I valued once with the status quo, the existing management, 1.6 million. Then I revalue it with better management in place, less like a public company, and I come up with 2 million. I've got two values here. First chance I give you is to bid for 49% of this company. You're going to pay 49% of the status quo value. Why? Because you don't get to run the company. You're stuck with the status quo. Whereas if you're offered 51% of the same company, you're willing to bid up to 51. You won't pay the entire amount, but you're willing to pay a much higher price. Which means the minority discount is going to be much greater at badly run companies than at well-run companies. Any Mets fans in this room? Come on, you can admit to it this season. They're at the top of the National League. Right? Until 2 years ago, who owned the Mets?
Oh, I have no idea.
Oh, come on, no, somebody must know.
I never bought.
This pathetic family called the Wilpons.
I never
Okay.
Steve Cohen bought.
And they ruined the team for, I mean, they lost a lot of their wealth with the Madoffs, and then for 11 years, they were budget constrained and the Mets felt the pain. Steve Cohen initially bought a small piece of the Mets, 6%. If you're Steve Cohen, you're offering 6% for the Mets, you're offering 6% of a really low value. Why? Because the Wilpons are continuing to run the team. 2 years ago, Steve Cohen bid for the whole team. Now you can afford to pay a much higher price because it's now going to be your team. That's really what the value of control is all about. If you can change the way something is run, you can offer a much higher amount. And maybe it's just your ego thinking that you can get a higher value. But that's what's driving the value of control, is the fact that you now control the leverage in this company. So I'm going to close this session with kind of a cynical look at value enhancement. Everybody likes value enhancement. Now, as I said, many companies really, when they want to talk about enhancing value, really talk about increasing prices. So for consultants, this is the mother lode of consulting fees. So if you think about premium consulting fees, McKinsey and Bain and BCG offer value consulting advice. So this is directed only at the top management. They come and tell companies, if you do this, your value will go up. Now, if you went in as a consulting firm and with a DCF model, and you said, here's the way you increase value, you got to cut costs and increase cash flows, and the CEO is probably saying, I knew that already. This isn't. So what consulting firms have struggled with is, how do you take this fairly basic process and make it look like it's a mysterious process that only they understand? So here's what they try to do. First, they say this DCF thing is too complicated, too many things. We'll minimize it. We'll tell you the one variable you need to focus on to increase value. CEO's eyes light up because now one number rather than 10 numbers. And then they pick a number. Now, the number could be market share or revenue growth or net income. But for consultants, it's nice if you can create an acronym that nobody's seen before. Okay? EVA, CFROI, and through the history of consulting, it's almost funny when you sit on the outside looking at these acronyms. Each one claims to be the newest, best way to value companies. And each one is a magic bullet. If you just do this, you're going to become this magically valuable company. What they have as a benefit is it's one number, it's simpler. But whenever you use one number, when you need to be using 5, you are making some compromises. And in the case of these approaches, those compromises can create some really deadly consequences. So let me give you 2 approaches that came out in the 1990s in the US, very widely used. One was something called economic value added, or EVA. I'll tell you what EVA is, and you tell me whether you find anything new, different, or sophisticated about what's in it. EVA is the difference between return on capital and cost of capital. That's new, right? We've never seen something. I mean, that's all we've been talking about all this class, right? You've earned more than. And here's what EVA says. It's nice to earn a bigger spread than a smaller spread. Oh my God, that's amazing. And if you can earn it on a larger amount of money, that's even better. I never knew this. And for this advice, you'll pay me $500,000. That's what EVA was. In the middle of the 90s, half of all of the S&P 500 companies were using Stern Stewart, which is the company that came up with EVA, as a consultant, paying them hefty amounts of money for this profound advice. So we shouldn't be earning less than the cost of capital. Oh my God, we never knew that. Now you've told us. The other approach is called CFROI. It's developed by an outfit called Holt Associates, a Chicago-based outfit. I don't know whether you remember in capital budgeting, NPV versus IRR, right? In capital budgeting, you do that in a project. NPV is a dollar value, IRR is a percentage number. Think of EVA as like a net present value analog. That's basically what it is. But the problem with NPV is it's a dollar number. And we tend to think in percentage numbers, right? That's what, if you think about it, what did you make last year? Nobody says $81. You think 15%. CFROI is like an internal rate of return. So what Holt Associates said is return on capital is this accounting number. It's backward looking. What we'll offer instead is this cash flow based forward looking IRR. That's what CFROI is. And if you adopt that, you'll become a valuable company. Now, at first sight, you're saying, but why do I need Stern Stewart? Once I know it's return on capital minus cost of capital times capital invested, I can do this myself. You've done this for your companies, right? ROIC. Here's what Stern Stewart did to make itself indispensable. And I'm not blaming them for it. Every consulting firm has to do it. They took the return on capital, and the standard definition is after-tax operating income divided by book value of equity plus book value of debt minus cash. And they said this is an accounting number, and there are a lot of flaws. In fact, there are so many flaws, we've discovered 164 adjustments we got to make to this number. before you can use it. 164. Now, some were obvious, right? Leases were not capitalized, they brought it in. So there were like 4 adjustments that mattered and 160 that were just pure noise. You know why they do that, right? You have no idea what works, what doesn't. You now need Stern Stewart to show up every 6 months in your company to just compute what your return on capital is. You're completely lost. And for that, they charge you $500,000, $1 million, $2 million, whatever it is. But with all of these approaches, the basic sales pitch is discounted cash flow valuation is complicated. If you use our metric, EVA, CFROI, we're going to simplify it. We'll give you a better, in fact, I heard Stern Stewart specifically say that using EVA will give you a better estimate of value than using traditional discounted cash flow valuation. In fact, some of you have asked me about residual earnings approaches. Residual earnings is an EVA approach. Basically, you're taking what you earn above the cost of capital. And the question is, why aren't we treating that as a different valuation approach? And I'm going to give you the answer in the next couple of pages. You're going to see why it's really just a reslicing of DCF and not a different approach. But the sales pitch is, if you use us, we're going to get a better estimate of value. So let me show you why this is not true. I'm going to take a company. I'm going to keep it very simple. The company has capital invested, book value of capital of 100 million. Every excess return model needs a book value to get started. Do you see why? Because return on capital is a book value number. Let's assume that this company expects to make a 15% return on capital on existing capital invested every year forever, and its cost of capital is 10%. So it's going to make a 5% excess return every year in perpetuity. And it still has some new projects to take. For the next 5 years, this company is going to invest $10 million in new projects each year, and those projects are also going to make 5% more than the cost of capital. I'm first going to value this company using an EVA or a residual income approach. Sounds magical, but here's how you do it. You start with the book value as the base. You take the excess returns from existing investments. That's the 5% that you're earning every year in perpetuity. The present value of perpetuity, add that on, 50 million. The new project you can take in year 1, take the excess. So basically, I'm just adding up the excess returns on all future projects. And by the way, after year 5, I'm just assuming you earn the cost of capital. So after year 5, I just stop. The value that I get for this company using an EVA approach is 170.85 million. So that's so if I was Stern Stewart, say, look how sophisticated this approach is. I get a value of 170.85 million. So I'm old-fashioned. I say, okay, I've used the discounted cash flow model. Let's see what the value would be if I used a discounted cash flow model for the same company. So instead of looking at the excess returns, I look at the total earnings and I look at I do what I do in a traditional DCF. I come up with free cash flows of firm, terminal value, because I've given you the growth rate in perpetuity. But if I discount my traditional DCF and terminal value, what I get as a value is 170.85 million. Pouring old wine into a new bottle doesn't make it better tasting. Taking a DCF and slicing and dicing it, which is what you've done in an excess return model, residual earnings model, doesn't make it a better model. Are there times you should focus on residual earnings? I think there's some good that comes out of thinking about excess returns, right? In fact, if there are 2 good things that come out of EVA, it's the fact that it focuses so much on earning more than the cost of capital. I think that's a good message. And it's also a useful tool for illustrating why companies sometimes trade at well above book value. In fact, in the EVA world, the only reason for trading above book value is because I expect you to earn more than the cost of capital over time. And in fact, I don't think that'll happen. Guess what's going to happen to market value? It's going to come down to book value. But we kind of knew this already when we did price to book ratios. So nothing in EVA was particularly new or different. But the 2 guys who founded Stern Stewart, Joel Stern and Bennett Stewart, could sell refrigerators to Eskimos. They were just great salespeople. And they found a willing audience and CEOs who wanted something they could focus on. But I'll tell you what the danger with what they did was. They sold companies on measuring performance with EVA. But once you measure performance with EVA, guess what the next step is? You tie compensation to EVA, right? Because you want EVA to go up. And they tied compensation to year-to-year changes in EVA. So the way this worked was, if you were the CEO of a company that adopted EVA, if you could increase your EVA next year, you got a bonus, you got options. So everything became about increasing next year's EVA. So I want to ask a very perverse, I want you to think about a very perverse question. Are there ways you can increase EVA next year while making your company a less valuable company in the long term?
You just take projects that are, or you would only take projects above the EDA average. And then
Or take short-term projects which deliver high EVA next year at the expense of long-term projects that deliver, much better EVA over time. But remember, your bonus is next year's number, so it drives you short-term. Second, if you take riskier projects, it turns out it takes a while for cost of capital to catch up with you. So the second game that got played was companies started, taking riskier and riskier business. Say, look at our EVA. And there was a third game they played. Remember, return on capital is based on that book value of capital. If you can find ways to make the book value of capital lower, magically the same earnings are going to deliver a much higher EVA. See, how do I do that? These were the days when you leased assets. It didn't show up as part of book capital. Remember, before accountants came to their senses. So companies that adopted EVA increasingly refused to buy assets. They leased everything because it made their EVA look better. All I'm saying is if you pick a metric like this and make that your central measure, you're going to get a lot of game playing around it. And that's exactly what happened to EVA. The kinds of companies that adopted it, it might have done less damage, but if you're a mature company and much of your good stuff is already behind you, you can get away with it. But you take a growth company and adopt EVA, terrible things can happen to your company because managers close. So when you look at in fact, in the last week, I've seen at least 5 new acronyms come out of consulting firms. And I'll send you a few of them. And I want you to be skeptical. Take it apart and say, what is this acronym doing? Because every one of them just takes basic DCF and kind of slices and dices it to make it look like you're looking at something you've never seen before. So please get your numbers in by Sunday night, and I'll send you the presentation for Monday before the class on Monday. So watch your emails in the hours before class, because I need the last numbers and to do those slides. But I will see you on Monday. Oh, also, I will have office hours, a 2-hour office hour session on Friday, and I'll send the link to that for project questions, because there will be questions that come up. So, there'll be 11 to 1.
I just have a lot of
I saw your